There has been much discussion recently as to why gold and other precious metals have not performed better given the current macro backdrop in the markets. Moving into 2022, it became apparent that inflation was much more entrenched into the global pricing structure than initially expected. This caused the Fed and other central banks to shift their tact and begin a monetary tightening cycle, which is ongoing. Gold prices went from 1806 to begin the year to a high of 2039 in the first 2 months. That equates to a 13% return, while the Treasury and equity markets were selling off. However, recent price action suggests that markets are discounting the possibility of inflation remaining elevated for an extended period of time. Forecasts continue to show that supply chain issues and the war in Ukraine will eventually have less impact on the pricing pressures, and the inflation will begin to decline. Couple this expectation with a strong US dollar, and gold is well below the March highs. Gold is currently priced at $1,850, which equates to a 2.4% year-to-date increase. Comparing this to Treasury and equity returns year-to-date, one could argue that gold has offered some counterbalance to other asset classes. It is also worth noting that the time frame for gold's ability to offer an inflation hedge is typically measured in duration longer than 6 months. Should the forecast for inflation be extended and the US dollar show signs of weakening, gold should benefit from these shifting expectations. Long term, gold still appears to be a viable inflation hedge.